All right, everyone. I welcome you to Month 4, Module 2. Today, we're going to be talking about the ICT order block. So I'm going to be explaining the concept behind the ICT order block and remove every ambiguity you may have. This lecture will help you identify order block when you look at the chart. Mind you, whenever you are taught anything, it will be very wise of you to go back to the chart and look for these things, practice them yourself, so that your reticular system is activated to the point that when you see it, you cannot see it. So everything takes practice, diligence, discipline, and consistency. Order blocks. The bearish order block is the highest candle or price bar with an up close that has the most range between open to close. It is validated when the low of this candle is traded through by another candle. How do you use it? A trade can be made when price returns to the order block after moving away or after validation. Now the risks. The high of the bullish order block is the location of a relatively safe stop loss placement. Also, just below the main threshold, which is 50% of the body of the candle, is a safe place for stop loss after price runs away in order to reduce risks. Now, what do I mean? Let me use this diagram to illustrate. So we can say that this is the up close candle that has the most range. We're not using this, we're not using this. Now, the moment price breaks below this low of this up close candle that has the most range, it becomes an ICT order block. All right. So this here gives us the confirmation that this candle here is an ICT order block. We don't just pick candles at random. We pick the candle that has the most range and price has traded through the low. We will call this a bearish order block. This candlestick provides a potential opportunity for profitable trades. Once price returns to this point from the low to the open of this candle, you can take a sell, trusting that price will not run above the high of this up close candle. All right. Now, as soon as price returns back to the low and open between these points, you can also use the range, but you don't want to see price go above this candle here, this candlestick here, because this is the bearish order block. We want to see price hit it and then rally downwards. Now, what's the whole concept behind this? Market makers bought into this candle to drive market higher. The moment they will sell, they want to take off their buy orders by allowing price to return back to this point for a sell. So you now, as a retail trader, want to follow the handwritings of the market makers. So this move we see here, this return back to this bearish order block, is only a fade. Is to drive in more buyers, to give more efficiency for market makers to sell. And there you have it. See how price found resistance in this bearish order block. It reacted properly and then rallied downwards. Now, when you see price move away from this bearish order block, you would want to move your stop to the mean threshold. What is the mean threshold? The mean threshold is the midpoint from the open and close of the ICT order block. When you see price move away from it, you can move your stop to this point, the mid threshold. But when you are entering, you can put your stop above the high of this bearish order block, because the whole concept is that market makers do not want price to go above this high. Why? Because they are already in a sell trade. Why they want market to go back to this bearish order block or this point, as I would say, is because they want to offload their buy orders. Just like I explained before, if you are buying to come out, you are selling. If you are selling to come out, you'll be buying. So because they bought into this up close candle, they want to come out of this trade. So they allow market to rally up to this point to give them the opportunity to come out, to mitigate their trades to drive market higher. Now, why are they driving market higher? They want to deceive buyers. They want to pull in more buyers. They need buyers to provide efficiency for market to run down. Because if I will use the example again, if I as a market maker, I have 500 shares that I am willing to sell, and I just have a sum of 50 buyers who each of them want to buy just one share, meaning that the total capacity of which every trader can buy is just 50 shares, and I want to sell 500 shares. So what do? I bring in more buyers by manipulating the market to make buyers or make other traders think that the market is going higher. And as they begin to buy and buy, it makes it possible for me to be able to execute my order for a sell. So when I have more than 50 buyers, or if I have more people who have the capacity to buy 500 shares, my order will be executed. So what happens? I lure in buyers. And when they've all come into the market, I then sell. But the buys that I bought here to move market to this point, I would want to mitigate. I want to come out of it. So I allow market to rally upwards, come out of those buy trades, and sell to make more profit. So with this understanding, when we see this up close candle formed, a market pierced through below the low of the candle, we expect that once price returns back to this point, the range from the high to the low, we expect to see market rally downwards. Now, there are other characteristics you have to look for that will help you know if an order block is of high probability, because you don't just look for any up-close candle that have price running through the low, calling it a bearish order block. It doesn't happen like that. But as we go on, we'll be able to understand how to identify high profitable order blocks. The bullish order block. The lowest candle or price bar with a down close that has the most range between open to close. It is validated when the high of this candle is traded through by another candle. Use. A trade can be made when price returns to the order block after moving away or after validation. Risks. The low of the bullish order block is the location of a relatively safe stop loss placement. Also just below the mean threshold, which is 50% or the midpoint of the body of the order block, is a safe place for stop loss after price runs away in order to reduce risks. Remember, you use the mean threshold after price has moved. You don't start a trade by putting your stop at the mean threshold. You want to be moving your stop to the mean threshold after you see price movement. You don't want to start the trade by putting your stop at the mean threshold and entering below. That is if you are using a bearish order block. Let me explain what I mean. Now you can see that this is a bearish order block. Now you want to enter from this point to this point. You could actually enter here, but the chances of price getting to this point within the range is low. So you want to enter where there's high probability of price getting to either the open or the low of this candle. Using the ICT order block, when you place your entry here, it is safe to place your stop loss here. Very, very okay. Because you don't want to see price go above this high. Once it goes above the high of the candle, then the trade is invalidated. Now, using the mean threshold, you don't want to start a trade by placing your entry here and then placing your stop at the mean threshold. Although you can see that price did not get to the mean threshold. But a couple of times you might get a market move where after price has created the ICT bearish order block, there is possibility that price might move to this mean threshold, take you out, and then run downwards. So what you should be doing is you want to see price move away, create the bearish order block, return back to the order block, place your entry and your stop at the high of the order block, and then expect market movement, which will give you the room to move your stop to this point. Because once you move your stop to this point, there is possibility that you want to add orders to your current order, because here has also created another new bearish order block. So once price returns back to this bearish order block, we would want to sell further, adding positions as price keeps retracing. Because now, if you enter with 1% risk here, if you move your stop to this point, you might have reduced your risk to 1.5%, giving you you reduce your risk to 0.5%, giving you 0.5% free risks to make as price rallies downwards. I hope you understand. So here is the ICT bullish order block. Like I explained before, you want to see that the high is traded through by another candle. You don't want to use this retracement as price returning back to a bullish order block. No, it hasn't traded above this high. You want to see price trade above the high first, then return. When it's returning, you can be assured that this here is a bullish order block because price has traded through the high. So you can see how price reacted beautifully here before rallying upwards. So this is a bullish order block. Now, one thing we should understand is that being able to identify high probability order block in the market is essential for making profitable trades. Not all candles you see on your chart is the ICT order block. I've already explained in the previous slides how to identify the ICT order block. But then again, I want to go further to explain how you can identify high probability versus low probability order block. What do I mean? Order block that has a high probability to hold price to move in the intended direction, and other blocks that have a lower probability of holding price to move in the intended direction. It is important to know that trading in the forex market is a game of probabilities. Therefore, you want to stack multiple strong confluences when looking for a trade setup. Now, if you've been following this mentorship, you've seen how I've been able to bring a lot of confluences to determine a bias. Understanding smart money is bringing a couple of things. You might not use all the tools. A couple of you may not use the other ICT order block. Some of you may use the fair value gap. Some of you may use the breakup. Some of you may use the liquidity run. Which one do you see more? But then you have to couple a lot of things like the smart money divergence, protraction, manipulation, reversals, consolidation, market open, displacement, ICT order block, order flow. A lot of things you can combine to form your own model. Which one do you see more? Because the game of forex will always be a game of probabilities. The same principles applies when using the ICT order block. The ICT order block has several features that appear to increase its probability of holding price in the direction of the current market order flow. Here are the features of a high probability order block, and they are very easy to identify when you look at your charts. Number one, you want to see the ICT order block with a strong and full body. You don't want to see a short body because we all know what a body is. If you've gone through the month one mentorship, here is the body, and then this are the weeks. So you don't want to be seeing something like this and then be calling it another block. You want to see something like this. Let me go back to the previous slides. You can see here, we didn't use this candle here or this candle here as the other block. This was what we used. And you can also see, if you look at the body here, strong, full body, full range. We're not using this, we're not using this. We want to see the candle's body with a full range. Now, the second feature is we want to see the order block with other internal range liquidity. I'm going to be showing you examples, even though the order block itself is an internal range liquidity. The last lecture, I explained external and internal range liquidity. And then the last is liquidity run order blocks. All right, let's get right into it. So the first feature is a strong and full body. We can see this candle here. It has a strong body. The wicks are short, but the body is full, stronger than the wick. I just hope we get it. You see this candle compared to this, you see that this has a full range. So this is what we'll be using for the order block. We don't use this. We use this candle that has a full range. And you can see our price reacted beautifully. And the same goes for a bearish candle. You can see this candle here. We're not using this candle. We're using this candle here. It's a full range body. I can see price reacted beautifully. Now, the second feature is an order block with internal range liquidity. If you look at this candle, you would see that it has internal range liquidity. And you can remember the internal range liquidity I listed in the previous video. Short-term lows, if it is a bullish run, you want to see short-term lows. You want to see fair value gap. You can see fair value gap here. So this internal range liquidity increases the probability of this candle holding price. So we want to see these things with the order block. This increases the chances of price rallying away from the order block. So you can see it's very easy to identify this when you look at your chart. Very, very easy. Same goes for the bearish order block. You can see internally, you can see this fair value gap. You can see short-term highs, short-term highs. As soon as price hits it, you can see how market rallied again the second time and then moved swiftly from this order block. Mind you, you want to see the low taken first before you consider it an ICT order block. The third feature, you want to see an order block that has run liquidity. So you can say that this high has been taken. The buy side liquidity has been taken and price reacted swiftly away from it. Now, something I want to point out. The manner at which price runs away from the order block is very important. So trying to look at price, like I explained in the previous video, for you to be profitable, the strategy has to be objective, not subjective. What do I mean by objective? You want rules that are rigid and not easily swayed. You know, if you look at white, you know white is white. If you look at black, you know black is black. You know, when you look at other colors that you are wondering, is this ash? Is this indigo? You know, ladies actually know a lot of colors. I always have issues with them because they will tell you a color and then if you argue with them, they'll tell you, no, that's not the color. So that is tilting more to the subjective. An objective rule is something that if you look at it, even a young child will say, this is what it is. So you want to have rules that you can easily identify. If you say you want to take trades and then your stop loss will always be 30 pips below your entry, that is objective. But when you are saying depending on the low that is formed, that is subjective. So to trade profitable, you want to remove fear. That is the goal. The goal is to trade without fear. Because why? Fear is an emotion. And you don't want to be trading with emotions. Emotions make you make decisions you didn't plan to make. Because the emotional part of the brain is the part that is not logical. So you want to create an environment for you to trade objectively. So what increases the probability of an order block is how market moves away from it. And when market moves with high momentum and displacement, it creates fair value gap. So this fair value gap is very easy to see. You don't want to see market moving like this. You see how market moved away. Then you will now say, okay, this is a bearish order block. You can see market took time before rallying upward, but you can see this movement. It moves swiftly with high momentum. And once market moves high momentum, it creates a least fair value gap. And fair value gap is very easy to identify. A young child can, a 2-year-old can look at the chart and identify fair value gaps. So you want to be trading with rules that a 2-year-old can identify. All right, so let's move on. So returning back to the third feature, you want to see the order block run above a high or below a low. Now, why is this important? Now, once price runs a high and then reverse this, you see this huge rejection here. It's telling you that market wants to return to the other direction. But we see price run a high and then it takes time. You can see this lag. Now, what's making me see that this market is not moving with high momentum or displacement? Because there's no creation of fair value gap. I see market moving back and forth. So it's saying that market wants to continue going higher. But when you see a run on liquidity above this high and the market retreats with huge displacement, sometimes breaking structure, you don't expect price to go higher to break this high because this liquidity has been taken. Market moves from buy side liquidity to sell side liquidity. So once buy side liquidity has been taken, market runs for sell side liquidity below the market. So you want the order block to have taken the sell side. You don't want to see something like this. You don't want to see a high here. Let's say high is created here, and the market rallied, and then create another block very close to that high. Probability of market going to take the high of that order block is high because there's a liquidity here. So you want to see that liquidity taken first, form another block, and then wait for market to rally before taking your sell. So I don't know if you understand this. It's easy, guys. Very, very easy. And the same for a bullish order block. So you can see how market broke the high. At this point here, you can say that this is a bullish order block. So you can see that market has taken liquidity to the downside. So you're expecting buy side liquidity to be taken. You want to see buy side being taken. Now you can see this move here, it created a fair value gap. This here is telling you that there is displacement, there's momentum, market wants to go higher. Now you can see that multiple times price returned back to this order block. But as you returned, it rallied. It created another bullish order block. You can see that liquidity was taken here. See how liquidity was taken here. Ah, awful. Let me draw that one. See how liquidity. Ah, why do I keep drawing it like this? See how liquidity was taken here. I tried this time. And then created another order block. As price breaks this high, it becomes the order block. So you can see fair value gap being created here. And then if you look at it, this is like the midpoint. You don't want to see price close below the midpoint. That's another thing again you can use to tell for high probability order block. Once you begin to see price close below the midpoint, it reduces the probability. So you can see that from this high to this low, this is the midpoint, somewhere here. So you can see that price is not close below the midpoint. Here, the same price is not close below the midpoint. And you can see how price rallied. So price created another order block here again. See, it took out this low, broke through to the upside, came down, and you can see a fair value gap. So you can see a lot of confluences here, increasing the probability of this order block. And you can see how price rallied. You can see another order block here again being formed. This order block has taken these highs, this high here. You can see it has fair value gap. You can see how market reacted. So if you train your eyes, if you go to the chart, you look for these things, you are able to identify high probability ICT order blocks. How can you implement the ICT order block? With a bullish monthly, weekly, and daily chart, the intraday 4-hour charts or less can present an opportunity by correcting or retracing lower into a discount, seeking sell-side liquidity for a buy. Pairing this retracement with an order block gives context to a high potential profitable trade. Now, this is a 3-month time frame, meaning that each candle represents 3 months. So you can see how market has been consolidated. It took out a low and then rallied upwards. Now, something I will have to say is this. Now, I'm giving you 3 features of high probability order blocks. If you go into the chart, it doesn't mean you're looking for another block with all 3 features. What you want to be doing is you want to blend a couple of things. You want to look for other block with 2, 1, or the 3. It's possible you can find the 3 features, but you want to find at least one. Either another block running liquidity, another block with displacement, creating fair value gap, and short-term lows, internal range liquidity, or another block with full body. So we can see that this other block has 2 of these features. That's taking a low and it has a full body. Coupled with context. You don't just look for candles that have full body and then taking liquidity. You combine these with context. Now this can be order flow, SMT divergence, quarterly shifts. Now you can see on that other block here, it has taken a low, it rallied, created fair value gap, and you can see how market reacted and then rallied upwards. So now we're going to be looking at this price action here, and then we'll narrow it down to this candle. You can see that this bullish order block has a full body, a strong body that's taking liquidity to the downside, and we are seeing displacement. This is a 3-month candle, guys. So if you see something like this already is telling you that there's displacement, although there's no fair value gap here. But we are expecting market to find support at this point to rally. So once you see this candle being printed, this is a down close candle, we're expecting movement from this level. This candle represents October, November, and December. So we're going to be looking at this candle here. We're going to be studying this candle. So this is a weekly time frame. Now we can see how market reacted in the monthly order block, the 3-month order block. You see how market rallied. So this is the point we are going to be studying. From this low to this high. This is the reaction from the order block. So you can see that if you go down to a lower time frame, there is internal range liquidity. See this lows, see this low. See how market has taken the internal range liquidity. But in this time frame, it is an external range liquidity, because if you look at it from this low to this high, this is external range liquidity. So once market takes internal liquidity, you expect market to return back to internal range liquidity. But with where we are coming from, the 3-month time frame, we're expecting market to react here to rally upwards. So we're going to be studying this area here. Good. And this is the daily time frame. Market found support in the 3-month time frame in this bullish order block, rallied to break structure to the upside. So we are seeing a break of structure. We are seeing that this order block has taken a low, and then we are seeing price returning back. So now we can see that there are only two features here. This order block here has a strong body and has taken a low. So it's another block with liquidity run. We can expect that price will find support here to rally. Explain the whole concept of liquidity. Once price takes sell side liquidity and rallies to break structure to the upside, we don't want to see price coming down to take the newly formed low. We want to see price keep going higher, because why? The liquidity here has been taken. So you don't want to see something like this. Price rally, break structure to the downside, clearing out these lows, and then rallies to break structure to the upside. Then come back down to break structure. Market doesn't move like this. Keep breaking structures to the upside. Do you understand? We see something like this. Market clears this high, takes stops, rallies, break structure. Once market returns, we call this a market shift. Market has shift in structure. It has shift from going bullish to now start going bearish. Or once market forms a low, and then price takes this low, rallies upward to break structure, we expect market to return back into this range to find support in any internal range liquidity before rallying upward. We call it shift in market structure. So I hope you understand. So seeing this happen here, it increases the likelihood of this order block holding price from going lower. So we want to see price go higher. Then another thing again we want to see is this. We want to see price close below the mean threshold. Now, I'm not drawing this perfectly well, but if you want to draw the mean threshold with more than one candle, you use the range from the open to the close. It's a bearish candle. Then if it's a bullish candle, you want to use the open and as well the close. This range here. I hope you understand. So the midpoint from this point here, the open and the close of this candle here, will be around somewhere, let's say here, I don't know. So you don't want to see market close below. So if we should use our fib, we'll get an accurate picture. Now we can see how market rallied from this point, broke through to the upside, creating another bullish order block. Now I put this here for a reason. You can see that this bullish order block doesn't have the three probabilities that I pointed out. It doesn't take a low, it doesn't have a full body, and there is no fair value gap, no internal range liquidity. Now, why will I want to use a low probability fair value gap here? Because I understand from my price action, order flow is bullish, because we are seeing reaction from a 3-month bullish order block. And on a daily time frame, price has rallied to break structure to the upside, returned back to this bullish order block, rally to break structure to the upside. So I'm seeing highs being broken, telling you that market wants to rally up to take liquidity, making this place an intermediate term low. Now you can remember from what I taught you in market structure, you can see that this low here is lower than this low to the left and the low to the right. So here has formed what? An intermediate term low. I don't want to see this low to be taken. I want to see price keep protecting this low. Now market can take lows. You can see short-term lows being taken. You can see that here is a short-term low. Market took it. You can see here too as short-term lows. Market took it, but still rallied. But what you want to be monitoring is the intermediate term low and the long-term low. At this point, you can see that here will become a long-term low. At this point, we become intermediate term low because of these lows that has been formed at the left and right. I hope you understand. So you can see how market kept rallying downwards. You see, this is a bullish order block. Market found support, rallied. Market found support here again before rallying. So let's go to a lower time frame, to a 4-hour time frame. So like I explained before, that 3-month candle we're studying is the month of October, November, and December. So let's look at the month of October. So I'll go back again. You see this arrow here. So we're going to be looking at this chart as a trader who will be taking trades hypothetically. Let's assume that these candles have not been printed. How would you go into the market with this idea? So once these have been formed, because this here is so powerful, we are seeing market reacting from the bullish order block, and we have seen that it has formed an intermediate term low here. And then we can see that market has created a bullish order block here. So we are going to move forward from this candle here. So this area is pointing this candle. So we're going to be going down to 4-hour time frame. See? So we can see this area. You can see that this intermediate term low is here. This low, this low. This is the bullish order block. And this is the low here. This is the open market rallied, then closed below, making it a down close candle. So we can see that a 4-hour bullish order block is being created in a daily bullish order block. With time, I will explain how you can use a bullish order block in a smaller time frame before a higher time frame bullish order block forms. But I'm be teaching it here because it's another lecture for another day. You can see that this bullish order block here in the 4-hour was formed before the daily bullish order block was formed. So you can be using it here. You can buy here. You can see market return back to it again. You can buy. And then you can see another order block here being created. Let me just expand it. So you can see the order block. Why is it high profitable order block? It has taken a low. Our market has broken structure to the upside. So we expect market to find support here. So market rallied. Market came back again. It's another opportunity because your stop will not be here. This is where you want to put in your stop. So once market rallies like this, you can move your stop to the midpoint. So like I explained before, see the market did not come back down to the midpoint. When you start seeing market going down to the midpoint, your stop doesn't have to be at the midpoint exact. It can just be a few pips below. Because you can see market might actually move towards the midpoint before rally. What you don't want to see is you want to see market close below the midpoint. But then again, you can see that as market rallied away, you can move your stop to the midpoint. But be careful not to be too quick to move your stop. You want to give room for price. You want market to move. So if you see something like this, you can then move your stop here or even to break even. Very possible. So you can see this bullish order block here. Something very interesting. It took liquidity to the downside, broke the high. Now this candle here validates this down close candle as a bullish order block because it has broken the high. We can see this huge return back to it in a 1 hour or 50-minute time frame. We'll see a retracement because this is a 4-hour time frame. You can see how this candle returned back to it immediately and then rallied. So we can see a consolidation here again. After consolidating, market created a bullish order block. As soon as price rallied above this high, it returned. We can see this week here, market returned. You can be using this immediate return to this bullish order block for a buy. Now you can see that market returned and disrespected this bullish order block and this bullish order block. I told you, when institutional order flow is bullish and other blocks are not holding in the current time frame, you have to step higher to a higher time frame and expect that the institutional levels will hold price. So you can see that market was returning back to that our bullish daily order block. Market found support, came back again, then rallied. On rallying, it created what? A bullish order block. Now, this bullish order block has something. What does it have? That's taking a low. Because now you can also use this order block. Why? Because this order block is finding support in a bullish order block, a higher time frame order block, and has taken this low. I don't know if it has actually taken this low, but if you look carefully, it has taken this low. Once this candle breaks above the high, it becomes validated. So you can see a market returned, rallied, returned. Now, when you see another block after another block, it is called a proportion block. You can see how it gave proportion to this move. Now, one thing I didn't mention is you want to be selling above highs. Once you buy here, you want to sell here. You want to offload your orders at the highs. Remember, internal liquidity to external liquidity. But you can see the market did not get to this point. Here, That's why whenever you are in a trade, you have to be taking partials. Now, once market takes this high, you can see how market returns. You want to take partials. Once market gets into this fair value gap, you want to take partials and then hold a little percentage of your position for price to run this high. You don't want to leave your full position from here to this point. You want to be taking partials. And even if you're not taking partials, you want to reduce risks by moving your stop loss to break even once you see market rallying this high, or you might want to do a trailing stop loss. So you can see as price breaks this high, it returned immediately before rallying. Here again, you can see market creating another bullish order block. What makes it high probability? You can see there's a fair value gap here. Now you can see another order block here. It has a strong body and it has taken liquidity and is finding support where in the bullish order block. So it has higher probability of holding price. As soon as price breaks above this high, the high of the bullish order block, you can see how market returned back to it immediately before rallying. And then, so we're in the month of November already. So we can see this here is a down close candle. But one thing it doesn't have a full body. You don't want to be using these types of order block. But one thing it does have is it has taken liquidity below the market and has broken straight to the upside. So once market is returning back to it, you expect that the market will find support to the upside. You can see here again, this is a proportion block because it is reacting from another block. And it has a fair value gap that's taking liquidity and market has broken structure to the upside. So we're expecting market to find support and market did. Even here to another block, I failed to draw it out. We draw it out here. You can see that this point here. Okay, market did not even get to it. But we can see here as another block, market rallied. So let's go to the month of December. So you can see here, let me expand. Okay, let's look at this point to see how market fell. Market fell. It kept disregarding. This other block did not hold. See as it fell just like hot knife through butter. Kept falling. And then this other block did not hold. This other block did not hold. Once you see this, you want to go down to a higher time frame. You can see how market found support in a daily time frame. Another thing we should also notice that once market found support here, it created an intermediate term low here. And this here is an intermediate term high. So once market breaks it, you want to resume a bullish trend. Why is it an intermediate term high? Because why? You can see it has short-term lows to the left and to the right. So you can use market structure to also determine market flow. Now you can see that market returns to this. Now what makes it high probability is taking a low. Market breaks struggle to the upside. So we want to see market find support here. And market did. Now you can see that some of the candles here are low probability order blocks, which is very okay. Once you've gotten your bias on the higher time frame and you understand order flow, you can use low probability order blocks. Low probability order blocks are very useful when you combine them with other strong confluences. But if you have very little confluence, you don't want to be using low probability order blocks. So we can see this order block here, it has displacements. There's internal range liquidity, this fair value gap here, which increases probability of holding price. Now, we don't just use this alone. We understand order flow. Market is reacting from a daily order block, and we know that it's running for this high because institutional order flow is bullish. So we are expecting market to run from external range liquidity to internal range liquidity. We are expecting a retracement. And after a retracement, we're expecting market to rally hard. Because why? This high has not been taken. This high was left untaken. So after this retracement, we want market to go high. Now, if you look at all these candles here, is there any candle that has the high taken and then a fair value gap was created? No. The high was not taken. This high was not taken until here. Once price takes this high, it created a fair value gap, telling you that there was displacement here. So once price is returning back to this point here, this order block, we expect price to find support. Now you can see here again, market retraced. This high has not been taken yet. We want to see this low being protected because order flow is bullish. This high should be taken before we allow any retracement down beyond these order blocks. So we can see market found support Here again, market found support. You can see there's a fair value gap, even as market has taken this high. Now, this is a very low probability order block, actually, because while liquidity has taken to the upside. Now, once liquidity has taken to the upside, you want to reduce risks. You don't want to go in with full risk because you expect market to retrace, and you can see how market retraced. Here is just a distribution to sweep out liquidity because liquidity is not just here. We have multiple orders lined up here, sell stops. So market wants to go to clear out all those stops for a distribution. This is where market makers offloads their trades. So I hope we understand. Beautiful. Now, a few key points. Another block can consist of multiple candles due to variability in the time frame being analyzed. So you can find that a 4-hour order block may consist of 4 order blocks in a 1-hour time frame. So it does because there are more than one candle doesn't mean it's not another block. But what classifies another block is that they are consecutively the same candles. So if it is a bullish order block, you want to see consecutively down close candles. You don't want to see a down close, like let's say 4 down close candles. You want to see 2 up close candles and 1 down close candle. You want to see all the candles being down close candles. I hope you understand. The mid threshold is the midpoint from the open to the close of the candles that forms the order block, and it is used to reduce risks after seeing price movement away from the order block. So for you to move your stop loss to the midpoint, that is the mid threshold, you want to see movement away first. Number 3, the probability of a bullish order block holding price reduces when price closes below the mean threshold and vice versa. So for a bullish or a bearish order block to hold price, you want to see price not close below the mean threshold. If this is a bullish order block, I want to see price not close above the mean threshold. You use low probability order blocks only when you have other strong confluences, like I explained before. You want to use other confluences that you see. When institutional order flow is bullish and you see smart money divergent, and on the higher time frame, market is bullish, you can be buying if you see low probability order blocks. The more recent order block in time, the more powerful. Now you want to be using the most recent order blocks. On a 5-minute time frame, you don't want to be using last month's order block in time. In a daily time frame, you don't want to be using another block for the last 2 to 3 years. You want to be using another block last month in a daily time frame, last 3 months. It's very, very okay. So if you are using another block that is far apart in time, the lower the probability of it holding price. And then that thing I didn't put out here, the higher the time frame you find the other block, the higher the other block. So a daily time frame order block is stronger than a 1-minute order block. And I don't advise that you trade off from a 1-minute order block, 5-minute order block. No, you want to get your bias from a higher time frame, not a lower time frame. So I hope you guys enjoyed this, and I really love your support by liking this video and subscribe for more content. Let me know what you learned in the comment section. If you have any question, I will be glad to answer. Thank you very much. And as always, I wish you a good luck and good trading.